Today, addressing your additional questions. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. And today I wanted to go through the additional questions that I was sent before our live stream last Tuesday. As you may know, on Tuesday we had a very large number of people on the stream, well over 800, and there were lots of questions asked live, so I didn't get a chance to cover off the questions that were submitted beforehand. However, I really value these questions, and I did promise, and I will now go through some of those questions and provide you some answers. So I hope that this show will provide a little bit more perspective and additional insight based on what happened on Tuesday, and of course the answers today will take account of what's happened over the last 2 or 3 days, and there's quite a lot of things that have changed. And just a little caveat, of course, this is not financial advice. This is just my own opinion based on my own analysis and research. But if you want to get specific advice, you need to go talk to a financial advisor. I am not a financial advisor. So just please take that on notice. So let's get started. Of course, these questions were submitted through our various channels over the preceding week or so. And that included YouTube directly, the DFA blog, and emails. And I want to say thank you to all of those who submitted questions. What I've done is I've picked the representative questions for the main themes that came through. So let's get started with the first set. So Hanny asked, now it seems APRA might change the 7% serviceability assessment a lot. Will this increase borrowing power? Will it make loans more available? And does it mean for first home buyers, should they buy this year? Well, the 3 things to say here. Firstly, yes, there will be a slight improvement in terms of the amount of lending that first-time buyers may be able to access, simply because of the fact that the rate of interest on first-time loans tends to be a bit lower. And that means that under the new scheme, which of course still has to be consulted on and won't come in for perhaps a month or 2, may make it just a little easier to borrow. However, it's worth reflecting on the fact that compared with 3 years ago, the borrowing power has been reduced somewhere between 30 and 40% for most households. And we also know that upcoming, we're going to see even tighter household expenditure measure benchmarks. And this means that the amount of lending that can be done will be strictly limited, and they will still be focusing on household expenditures down to a much more granular level. Now, I don't think this means that they will necessarily ask every time for detailed expenditure calculations, but they will be using a revised and more robust HEM. So I think the short answer is, yep, there will be a little bit of loosening, but not a lot. And you've got to make a decision as to whether you think this is going to fundamentally change the market. My own view is that there might be a little bit of short-term improvement, but as we discussed with Edmund the other day, and also with Chris Bates, we think that home prices are probably likely to continue to slide for a bit further. And that means that anybody who's a first-time buyer thinking of getting into the market should be really careful, and it may be worth continuing to save and making some decisions, not immediately, but perhaps next year. So Mike says, thanks for great work. Quick question for tonight. Do you think that property prices will continue to fall in postcodes which, according to your research, have low volumes of mortgage stress? We're looking to buy in Penrith, and the prices seem to be going down rather slowly so far. And your map indicates that currently there is little stress. Okay, so the thing to understand here is that stress is not necessarily directly correlated to home price falls. What really drives home prices up or down is availability of credit. And it's clear to me that in the areas around our major cities, we are seeing some tightening of lending standards now, and that will continue. And I mentioned just now, HEM will get ever tighter. So my perspective is that we will still see home prices begin to slide further. And there may be a little bit of sideways wobble over the next 3 months or so, But I think the thing to understand is that once we get into the spring season, my own feeling is that there will still be further falls ahead. We'll see. I would just monitor the situation and make decisions a little later. Certainly, mortgage stress, though, is not the only determinant of where home prices go. Jill said, "So I missed the boat. Will Sydney property prices rise again? I was going to wait for perhaps lower prices next year." Yeah, Jill, I think that don't panic is what I'd say. There may be some sideways movement on prices, but depending on which part of the market you're looking in and the type of property you want to buy, it's probably going to continue to slide. As Chris Bates said the other day, maybe the only exception is houses in the inner ring where they're on really good spots and where there is limited supply. In areas where there's high supply, new building, a lot of investors trying to sell, we think property prices will continue to slide. So it depends where you're looking and what you're looking for, but certainly don't panic. I think there's still plenty of time to make decisions, and I still have the view that this time next year prices will be lower. Jason said, "Been closely following the conversation around bank bail-ins in Australia. Recently had correspondence with a professor of law about bail-in, and basically the commentators were referring to bail-in as stealing deposits. In his opinion, his thought that bail-in done correctly is quite likely to save deposits. What do you think about it?" Yeah. So here's the thing. Bail-in is a mechanism to keep a bank going. So bail-in is done when there is a problem with the amount of capital the bank has, and deposits are converted to capital to support the bank. So in theory, that should allow the bank to continue to trade, and that means that the deposits, although they may have been converted to shares, are still there. The question is, of course, what is the conversion ratio? And if you want to get out later, can you sell those shares and get your deposit back? Now, the complication is that, one, deposits at the moment are not priced as if they were risk assets. In other words, you get very little returns for deposits in the banks. And surely, if they were an asset that could be converted to shares, you should be paid a higher rate of interest. Two, it's not clear to me whether the conversion ratio will be 1-to-1 and whether you will get it all back. So there are extra risks around deposits if bail-in is executed. And if you want to look at that in more detail, look at what's happened in New Zealand, because there they've been very explicit about the way that bail-in might work. Three, in Australia, there is still a public stance that bail-in is not going to happen for deposits, will not happen and cannot happen. We're not quite sure that that is completely accurate. And there is international pressure from the likes of the IMF and the Financial Stability Board for Australia to have stronger bail-in provisions ahead. So it's worth watching. I think it's certainly true to say that on one hand, bail-in could protect some deposits, but two, the bail-in could also devalue deposits and make them hard to get at. And in fact, if you look back in Greece and some of the other places where bail-ins happened, basically the deposits were down in value by 20 to 30% and locked into shares for some time, and that meant that your deposits were not easily accessible. So way more complicated perhaps than an either-or answer. And Mark said, interest-only lending restrictions are now easing. APRA lifted the interest-only cap in 1 Jan. My positive-negative credit watch announcement ratio crossover from negative positive. This is a 6 to 12-month leading indicator on Sydney home prices. So the question is it that prices are likely to go up? Well, I think there's some evidence to suggest that in some places and in some cases, prices could begin to rise. But as Chris Bates said the other day in his post, it will be for houses in inner regions around Sydney, on big plots with high amenity values. Whereas units and apartments and outer urban properties and in the effectively the ring around the edge of the city where all the new construction is, prices will probably slide. So it's not a simple answer. And there will be a little bit of loosening of credit standards and more loans available. However, we know that HEM is being tightened and banks are still less willing to lend than they were previously. So my own net view is that depending on where you're looking and what you're trying to buy, you can still expect prices to continue to slide. And in fact, it may well be that we see a little bit of temporary relief and then a more severe slide later. So I'm not convinced that the market has fundamentally changed. And I know that's what the mainstream media is saying, but I'm not sure that they've actually got it right. Okay, let's go on to the next set of questions. This is from Harold. Thanks for your tireless work and videos. I think your message is reaching more and more ears and is now changing in mainstream media narratives. My question is, could you please explain the definition of credit in charts presented by yourself and Steve Keen, when it looks like debt has grown exponentially, while credit only cycles up and down between a narrow band? Okay, so I think there's a couple of points here. Firstly, when I measure debt, I look at total household debt, which is effectively the total pool of loans out there. Now, then we need to look at the rate of change of credit. How much are new loans being written, and what's the rate of change? And of course, I've shown that the charts are showing that the rate of change is easing at the moment. So I think to understand how Steve is thinking about it, it's the rate of change of credit. He, in fact, measures it relative to GDP. I measure it in absolute terms based on the RBA data. But the total value of debt is still rising, but the rate of change of new credit is slowing. And that's partly because there's a lot of refinance going on, and refinance, of course, includes some redraw. But the real important factor is the number of new loans written. In other words, how much people are borrowing and how much new business is being written. Now, it may well be, after the recent changes in underwriting standards and some of the other things that have happened after the election, that we see the rate of credit growth rising again. And if the rate of credit growth does start to rise, then that will signal potentially home price moves ahead in about 6 months. So watch this space. James says, property price falls, underpinning factors. It's clear to me that there are at least 3 immediate circumstances that could arrest price. First, lower property value ranges, linked, of course, to rental return, where the same dwelling generally has equivalence in the cost to rent. And thirdly, the same property has the cost to build. So the question is, given those factors, how does that triangulate with property price falls? Yeah, good question. So if you look at it in around Sydney and Melbourne, on average terms, if you were to build on a new plot and add in all the costs of construction and amenity value are appropriate, prices would be about 40% lower, even now, than the current asking prices. So in absolute terms, to get back to an equivalence position, prices should drop around 40%, less in some of the other centres, but in Sydney and Melbourne, that will be about right. Now, when it comes to the rental returns, well, rental returns are falling, of course, because real rents in Sydney are going backwards at the moment, down about 3%. And if you do the calculations based on current rental returns and the costs of borrowing, around 60% of investors are actually underwater at the moment, you'd have to see property prices drop somewhere between 20 and 30% to be able to actually make the calculation work, assuming no capital growth. Now, of course, if you're a property investor and capital growth is there, that changes the equation, and of course you can get tax benefits. But if there is no capital growth, then the tax benefits are potentially much more limited. So there is definitely some sort of floor to home price falls, all else being equal. And in our basis of calculation, we still think that the 40% fall is a true value point. Others will disagree, I'm sure, but that's our own perspective. Stefan says, I highly appreciate your content and analysis of the Australian economy and housing markets. I've been checking the core index, home value index, and it jumped from 151 to 151.48, and that was May 2019. This is a substantial change for head-on index, and the most extreme daily changes of the index that I've seen for a long time. It also reduces the drop in the month of May. Now, while it makes sense that equity markets have reacted to the election, I find it strange that the hedonic home price index has also jumped. So, is it just coincidence, or is something else going on? Well, it's an interesting question. Now, of course, the hedonic index is essentially looking at a whole bunch of different factors, and they do update the index daily based on new information. But yes, that move does seem to me to be quite a large one, and it shouldn't really be reacting to sentiment. It should be reacting to fundamentals. Now, We'll have to wait to see what CoreLogic says about this and whether in fact the index comes back. But if you think about the way they calculate it, they use a whole bunch of different inputs, including the nature of the property, including current information from settlements. And of course, settlement information is delayed by 3 to 4 months relative to the transaction itself. I think it's more to do with history than the election results. And my own view is it's probably just a coincidence. Tony says, that was a great talk with Tony. I think you mean Tony Locandro. Really enjoyed it. One problem that concerns me is that both you and Tony don't discuss the housing debt problem as a global debt problem with 250 trillion in global debt. It's not just housing, it's everywhere. So the question is, how does it all play out, I guess? Yeah, I agree. We can't cover everything on every post, but we have been quite clear that the global debt problem is the big problem. We have more debt globally than ever before. We never really recovered from the global financial crisis, and a lot of that debt is spread between households in some countries, like Australia, and corporates, like in the US. Now, the amount of debt that's in circulation is driven by, firstly, quantitative easing, which has lifted asset prices and also reduced the cost of borrowing. And now, of course, central banks around the world are looking probably to drop interest rates over the next couple of years, which will allow debt to grow even faster. Now, the bottom line is this. Many central banks and bankers don't believe that debt itself is a problem. They believe that debt creates assets, assets and debt effectively cancel each other out, therefore it's not a problem. However, we have a view that debt is a real problem. It's probably the biggest issue that we face. And therefore, the housing debt here in Australia is a pale manifestation of a global debt problem. So I absolutely agree with you. It's just that in every post, we can't cover everything. But if you look at some of the posts that John Adams and I have done, we've spoken about global debt and the implications. Hi, excuse the interruption, but if you are getting value from this post, please consider subscribing to DFA if you haven't already done so, or ring that bell for custom alerts. Plus, please consider supporting our efforts. You can make a one-off donation via PayPal, here's the link, or subscribe via Patreon for as little as $3 US a month or more to get access to exclusive additional content. The links are in the comments below. And thanks for supporting what we do. It's really appreciated and makes it possible for us to continue to make more great content. Maria said, I know there is talk about the Reserve Bank cutting the tax rate, I assume you mean the cash rate, to prevent a recession. But my question is, how does lowering the RBA rate affect the country, aside from mortgages? Does it affect the reserves? What are the flow-on effects if the RBA is too low? Good question. So the point about the interest rate dropping is that it makes consumers feel a little richer because effectively their mortgage repayments may go down if they are passed on by the banks. However, you've got to understand the international context here. If the cash rate goes down, international investors potentially will become less interested in investing in Australia. Indeed, now the bond rates in the US are better than in Australia. And what that means is that there is a risk that the exchange rate will drop, and quite consistently and considerably. And if the exchange rate does drop, because cash rates are lower here, that means that the price of imports go up, and that means anything from oil and wheat and anything else we import. And it also means that investors overseas are going to be looking for higher returns to be able to actually make it all work. Now, a lot of our international debt, there's more than $1 trillion of debt, is actually denominated in Aussie dollars. And if the exchange rate drops, that means that the cost of that debt goes up. So it's really those broader impacts which need to be understood. You can't just think about the cash rate impacting the local economy and easing things up. You've got to think more broadly about the international markets. Plus, if the cash rate is cut, it's a signal of less confidence in the local economy. It is not a good sign when rates are so low. And you need to think about the confidence aspects of this, both locally and internationally. And my own view is, if the rates are cut, exchange rate will drop, and we will import inflation, and down the track, the Reserve Bank may have to change course and lift rates. Otherwise, inflation will get out of hand. And that's, of course, how hyperinflation ends up, where effectively the valuation of the local economy goes down. Interest rates are very low, but unfortunately, that doesn't solve anything. But here's an interesting question. there's a professor of economics who basically criticized Steve Keen's view and said that Professor Keen didn't really understand what was going on. You can look at it. There's a link there to the show if you want to look at it. Yeah, there's a fundamental difference of opinion as to whether debt's important or not, right? So there are people who believe that debt is not a problem because debt creates assets. Assets and debt cancel each other out. Therefore, it doesn't matter how much debt you have in the system. And in fact, good debt, if it leads to big investments, can be helpful. And of course, MMT is an example of that. So basically, modern monetary theory says, sure, it's fine for a government to borrow. It's not like a household budget. And you can actually use that for productive investment. So it is down to a question of whether debt is important or not. Now, my own view is that the neoliberal view that debt's not important, and therefore we can just go on inflating it forever, is a bit myopic in its own right. So I'm afraid that I subscribe more to Steve Keen's view that debt's one of the most critical things to look at, because debt has to be repaid, firstly, and secondly, debt costs. Remember that debt requires interest rates. Now, interest rates, of course, drive repayments, and repayments drive the profitability of the finance sector. So essentially what we're really saying is that bigger debt drives a bigger finance sector, doesn't necessarily drive a bigger outcome for the broader economy. So I'm afraid I fundamentally agree with Steve and disagree with the other professor. Anthony says, any analysis available to show how much more a first homeowner could borrow under the new serviceability requirements? Yeah, so it looks to me, on average, it'll be somewhere like 5 or 6% more, based on the assumption that the rates are executed per APRA's discussion paper. Remember, it's not done yet. There's a discussion paper, there's a response period, and that closes in about a month's time. So there will be a little bit of upside, but as we discussed earlier, their banks are also tightening HEM, and they're looking more at expenses. So you have to offset that. And you also have to bear in mind that different rates will apply for different types of loans and from different lenders. So rather than moving to a standard 7% plus ratio, now each lender will be able to set different rates. And I suspect we'll see some variation among different lenders. Some will pursue first-time buyers more strongly than others. And if they do, they may well offer slightly bigger loans. However, I don't think this is a return to the heady days of 2 or 3 years ago, personally, and it will have only a marginal impact. And of course, they said initially there'd be only 10,000 loans per annum, so it's not likely to move the market that much. And what I say to first-time buyers is you need to be very careful, because if you're buying into a falling market, you lose your equity very quickly. Negative equity is a tyranny, and so people need to be really careful. This is an attempt to try and pull first-time buyers back into the market to support the broader market, and be very careful, because effectively people will try to sell into first-time buyers. They are essentially looking for a greater fool, and the first-time buyer changes potentially means that there will be perhaps more fools willing to purchase. Paula said, for your live discussion, is now the time to purchase real estate? How do you determine when the market is the best in the best position to buy? Does one wait for the economic tipping point in supply-demand, then enter? Agents where I live are still overpricing and talking BS. Wow, very interesting question. Hard to know, right? So all of the publicly available information, remember it's often filtered, remember it's often delayed, is also very much engineered to try and encourage people to buy into the market. You know, the government wants people to buy real estate. The Reserve Bank wants people to buy real estate. The reason is it's one of the strongest levers in terms of creating economic momentum in the country. But it doesn't actually mean it's right for individuals. And lenders, of course, will make loans, but they will perhaps often make loans bigger than are sensible for individuals. And so individuals need to understand that just because a bank says they can borrow doesn't necessarily mean it's the right thing to do. In terms of leading indicators, I look for 3. Firstly, I look at the rate of credit change. So credit momentum. If credit momentum is continuing to ease, that tells me that home prices are going to continue to fall. And therefore, there is absolutely no need to do anything quickly. If, on the other hand, that changes, you might want to bring your decision forward. Also look at home price trackers, but of course these are very out of date, 3 to 4 months, and don't really tell you that much. And thirdly, don't believe what real estate agents tell you, because they have an axe to grind. you need to get some more objective independent views, but there are some agents who actually are better than others, so get multiple views and listen to people talking about the local markets, because the averages across the centres mask significant and important differences. So what I'd say to you is tune your BS monitor. There's plenty of it about. Brian said, given we've had a significant percentage of your favoured scenario drop in Sydney already, and panic is not really set in, do you think that a controlled descent to the bottom over the next 12 months is plausible, or is a plummet the most likely and only scenario? Well, good question. We've updated our scenarios, of course. We discussed it on Tuesday in detail, and we're not suggesting that in all of our scenarios there will be a significant crash. We're saying that prices will continue to grind down over the next 2 or 3 years. In fact, our central scenario is a peak to trough fall of between 20 and 30%, of which, of course, we've had in some areas that pretty much already. In others, the average is sitting at around 12 to 14%. So perhaps we're about halfway there. Now, my point is that if there is no external shock, and I mean by that the US trade issues with China, I mean Brexit, I mean Deutsche Bank, I mean China, any one of those could trigger a significant financial correction. But without those in play, then the 20 to 30% fall in Sydney and Melbourne over the next 3 years from peak to trough is still on, I think. And that doesn't mean that there's going to be a crash. It's going to potentially be just a grind down. Now, it could be that we see a little bit of a bounce over the next 2 or 3 months because of all the hype after the election. But once the smoke clears, the fundamentals really haven't changed that much. And we'll update our scenarios. Of course, the scenarios are driven by consumer sentiment as well, and we'll get data from that over the next month or so, and we'll plug that in. And we'll see what happens to the lending statistics as well, because the model is sensitive to all of those inputs. So if things change, we'll update the scenarios. But at the moment, I'm holding on my central scenario of falls peak to trough over 3 years of 20 to 30%, and we're certainly not there yet. Okay, so sheet 6. What happens if in future Australia does QE or, say, fiscal stimulus? I think we know that the Aussie dollar might hit. But other than that, what would happen broadly to housing and to the economy? Have you done any modelling? Yeah, so obviously it depends on precisely how this plays out, but you can look at what happened in the US. And there were 3 things. Firstly, we saw that asset prices rose. The stock markets were very strong, and there was also a rise in property, although not as strong as stock markets. And as the central bank pumped in more money into the system, no surprise, asset prices are just bigger. That supports the financial sector, and that supports the wealthy. So I think in a QE scenario, some proportion of the population will do very well, and those particularly holding stocks and shares. But secondly, there is also an impact on debt, because essentially the amount of debt in the system grows. And debt, of course, has ultimately to be repaid. And the risk, of course, is that the debt will cost more, and that puts a burden on the population, not immediately, but down the track. And that's what we're seeing, of course, around the world with massive global debt. The third point to make is that this is something which is hard to reverse. So a decade after the US did QE, the unconventional policies are still in place, and they are threatening to do it again. So the problem is you just ratchet interest rates down, you inflate debt higher, you inflate asset prices, but you don't fundamentally tackle the underlying issue that is there, which is that the economy is not structured correctly. And in fact, you support the finance sector and you build momentum in that part of the economy at the expense of true real investment in the real economy. And that's the problem. So it seems to me that QE and all those strategies are a one-way street to mayhem. And unfortunately, it creates problems not just now, but down the track. So the next generation coming through will find it harder to buy property, will find it potentially more burdensome because of the amount of debt in the system. And ultimately, unless it's reversed, this is a bit of a road to a bigger crisis down the track. Tim says, thanks for your great content. I have a question. I'm a first-time buyer waiting for the market to bottom. Does this mean it's the best time to buy? Well, I think you should go back and listen to Chris Bates and Tony Locantro and indeed Edwin Almeida, because all of them, from their own perspectives, are saying, be careful. This is not necessarily a good time to buy. Prices probably won't recover. And I continue to also believe that prices will go sideways or down into the future. People are being cajoled into the market, enticed into the market for broader economic reasons. But in an individual circumstance, you may well end up losing some of your deposit. And I've always said, if you need to buy because you need somewhere to live and you can afford to do it, even if there's no capital growth, then maybe it's a reasonable thing to do, because housing is about home and shelter. But if you're thinking of buying with a view to seeing capital growth in property down the track, which of course is what we've had for a generation plus, I'm not so sure that ahead that's going to be the way it plays out. So I would be cautious. I still think there is plenty of time left. So continue to watch our shows and watch the indicators, things like credit impulse, things like home price indices. But I don't think there's any burning platform. And frankly, all of the efforts from the government and from the regulators to encourage people back into the market is more of a sign of desperation than anything else. Ron said, my question and my concern, before the election, Morrison pledged that he would reduce the Liberal Party's mass immigration levels. But as real estate prices continue to fall, I'm worried that the government will do the complete opposite and start flooding the country with higher than ever before record-breaking migration numbers to create an instant shortage of housing and demand, forcing prices to go back up. Yep, so there's no doubt in my mind that migration is seen in many quarters to be the solution to our problem. But remember this, there's more than 1 million properties out there that are empty at the moment. We've got more than 100,000 being built at the moment this year, more planned next year, and more consents ahead. So there is plenty of property supply. Secondly, those migrants coming into the country don't necessarily have the wherewithal to buy property here. And of course, you might have 280,000, 300,000 people come in, but they come in as family units. That means there's a relatively smaller number of people who actually are able, willing, and want to buy. Many of them rent or live with family or friends initially. And the third point is that given the disequilibrium between supply and demand, and the fact that many people want to sell property, particularly down traders and investors wanting to get out, we're going to see continued supply, more time on market, and therefore lower home prices. So yes, I'm sure they will try to bolster home prices by increasing migration. I'm not necessarily convinced that it will be successful. And of course, there are downsides to very high levels of migration, including congestion and fighting for resources, be it water, be it land and space, and other things too. But remember this, there are more than 1 million vacant properties in Australia at the moment, according to the ABS census. So there is not a lack of supply. So there you have it. Well, I hope you found those answers useful. And just a little caveat, of course, this is not financial advice. This is just my own opinion based on my own analysis and research. But if you want to get specific advice, you need to go talk to a financial advisor. I am not a financial advisor. So just please take that on notice. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.